Let's bring in Kim Forrest, Vice President and Senior Portfolio Manager at Pitt Capital Group, and Sean O'Hara is here, President of Pacer ETF. Sean, what do you think about this idea that rates will rise significantly in the third and fourth quarter and stocks will go up significantly along with them?
Well, we've had, 8 to 10 years of very, very aggressive interest rate policy. If you look at historical measures, take inflation and add a spread to it, the Fed funds rate probably should be 3 or 3.25 right now, and the 10-year probably should be, under normal circumstances, 4 to 4.5. So we're adjusting to this change from basically free money to more normalized interest rate policy. And I think the market's strong enough when you look at earnings, when you look at wage growth, when you look at unemployment, you look at very low inflation, all of that's probably strong enough to carry the market higher going forward.
Even in the face of higher interest rates?
We're not talking about rates going from 3% on the 10-year to 7% overnight. Sure. We're talking about marginal increases that really price money at a more reasonable rate given where we are. So I think as long as we don't see an insane increase or interest rates run away.
What is a reasonable increase? From 3 to 4?
Well, yeah, I think,
which is a 33% higher yield.
I understand it's on a percentage basis, it's bigger. But I think when you look at historically where interest rates tend to sit against inflation, we are under that number currently. And I think we have room to move. I think the one thing that may force rates to not go higher in a kind of crazy way is that when you look at the 10-year Treasury compared to, and I made this point the last time I was here, other developed markets 10-year paper, we're at the high end of that in terms of yield. And so if we start to spike interest rates up on the 10-year, that will cause buying because people would rather buy U.S. paper, I think, than some other developed nations paper, and that may tend to suppress interest rates.
Kim, in terms of the view of the market, do you agree with Paul Tudor Jones? And is there a risk to the upside when it comes to interest rates? Because he's predicting interest rates to rise in the back half of the year, mainly, I mean, this is what I got from the interview, mainly because of Fed action, but there's also the stimulus kicking in, and we could see that impact greatly later in the year, too.
Sure. Well, I don't know what Paul is thinking, but what I think by saying that if interest rates and the market goes up dramatically, the only reason that that could work is that the economy is like super, super strong.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.